What's up, everybody? I hope you're having an amazing day. My name is Colin. Here we have Rick. And today on Launchpad School, we're going to dive deeper into vesting schedules. Quite interesting, of course, when tokens are being vested, which means, well, what it means I will explain in a second. But there's a big opportunity and also pros and cons to the situation. One good thing is that it creates a lot of room. Obviously, on the other side, it creates dilution, which is something to be considerate of. So websites we'll use today, CoinMarketCap, CryptoRank, will basically go over everything. And Rick, if you have any questions along the way, feel free to send them in. If anybody else watching this live from the Digits Club has any questions, feel free to post them in the chat. I have now enabled it for you. I'm going to send a message. Hello. And then I'll keep the chat open. So with vesting, the most important thing is when we participate in any type of round, right? There's always a token generation event, right? Before the investment happens. I'm going to pull up Citus Heroes project right here. So let's say we joined on the paid ignition launchpad. We want to see the details. And when you make an investment on the paid network, you get 10% on the token generation event and then 10% monthly for 10 months, which basically means that, well, 10% for 9 months because you already got 10%. This is what they do to prevent the token from dumping, right? If there's a huge influx in the supply, but there's no demand, price goes down because there's an oversupply, which is not what they want. So to prevent people from dumping, they basically slowly allow drips of the token. So the possible dumps, right, are being caught and then they can move that forward. So that is definitely the best strategy to use. Oftentimes we see 0% token generation event up to 100% on the public rounds. So that's the IDO. And then once you go deeper into the rounds, private usually has longer vesting, as you can see, 5% at the TGE, then 3 months, nothing. And then for 21 months, they get their tokens, right? Very long. And then you have a seed investment, which has 5%. Oh, it's the same as the private, as you can see. Right? So the data in CryptoRank is not always super accurate. So do make sure to double verify everything you see on this website. But it's basically to explain the vesting. There's usually an amount at the TGE, token generation event. That's when the coin is being created and the initial supply is being distributed, but not always. Then there might be a lock. Here they say 3-month lock, which we sometimes refer to as cliff. Right? Basically, the cliff is the period where you don't get any tokens. And then every single month, either you get the tokens airdropped or you can claim through a claiming portal your tokens. Now, of course, when this vesting happens, there are opportunities. So there are different situations where we're going to look at today from an investor point of view, where we have joined the project, and also from an investor point of view, where we have not joined the project. Cool?
Yes, sir.
All right, perfect. I'm going to pick up FN, which is one of the token sales that I did in both private and public. So I did the private sale directly with FN, just this one, I think. 6-month cliff, 18 months vested. Is that correct? Yeah, I think so. And then I did the IDO round as well, which was 10% released at TGE, 10-day lock, and then 1% release daily. So apparently that's also an option. There are basically these vesting schedules, they're custom, right? They can do as they want. So the ROI that you would have achieved right now is basically minus 60% on the sales price. And then the private round, because it's so much lower, is still in the green. And then the seed is also still in the green. But there were a lot of different rounds. As you can see, the prices vary quite a bit. So the question is, once we look at when that TGE happened, right? So we see the IDO ended on the 28th of January, 2022. So we go, I'm going to close the chat. We go to CoinMarketCap, type in FN. all-time chart. So you can see that they went live. So CoinMarketCap usually has a 1-day delay, right? So important to note, because when a coin gets listed, it doesn't immediately get picked up by CoinMarketCap, usually takes a day. So they say from the 28th to the 29th, the token generation event happened, and it got listed the 29th. So almost the 30th, right? 29th, 30, basically very quick. So you could see that basically it didn't get tracked properly from the graph, right? That's why it's a flat line, but it went up in the beginning. So the IDO price was 14 cents, the public price. So it definitely did really well on the launch, like a 10x. And then just a week later, it came down, right? And if we then zoom out all the way until today, the market is extremely bearish. So it's holding below IDO price right now. One thing that is really important to note for a project like FN is that 10% TGE, 10 days lock, and then 1%. So we're talking 90%, 90 days, right? 1% per day. Make sense? So if we calculate 90 days, right, 30th of January, we end up 30th of April. So after this, there's no more public round vesting. It has been completed, right? However, for the private round, there's a 6-month cliff and then 18 months vested. So 6-month cliff is they just started being vested in July. So the circulating supply is still being diluted. What does that mean?
Still people are able to dump, essentially, to sell their tokens as they're being released.
Can't hear you.
You can't hear me.
Well, I can hear you, but the volume is really low.
Interesting. Oh, I know why, actually. Let me, yeah. No, I don't know why. That's odd.
Yeah, maybe it's me. Maybe I just need to up my volume. That's also an option.
Maybe someone in chat can say,
oh, yeah, no, this is fine. This is fine. Now I'm blowing my ears up. Oh, good. It's my bad. Sorry.
Let's see. What does that mean?
Yes.
It means that there's still people being able to get their tokens just now. So there's still people being able to sell their tokens that they got from the TGE, from the private rounds.
Yes. And when I want to look at financial terms, right? Remember what we always say, it's the most difficult part, right? We don't want to be descriptive. We want to talk in like analytic format. So if the token is still being vested, it dilutes the supply. What does that mean?
I'll need a good description on that.
Yeah. Okay. Supply goes up, right? Because there's more supply, and demand stays the same. So what happens with the price?
Suppose it gets diluted.
And what does that mean in this case?
Wait, okay. So the demand stays the same, but the price goes up. So it devaluates.
No, hang on. So the demand stays the same. The supply goes up. What happens to the price?
Okay. Then it goes down. It deflates because there's the same amount of people that want it, but the price is the same. Right. Yes. It goes down.
Because, so it's always a question of supply and demand relative to price, right? That's economics, supply and demand. So if supply goes up, demand stays the same. It's inevitable that the price will go down because people have the option to sell and they will. If there's 100,000 people, it's unlikely that nobody will sell. So some people will sell, not everybody, but if there's no increase in demand, price will go down. You can basically see that from the volumes as well. When there was a lot of action, the daily transaction volume was 1 to 3 million. Right now it's 300K, right? And on the macro, of course, it's important, but the circulating supply is being diluted. What that means is that the relative value of your tokens for the ecosystem also goes down. So let's say there is, the max supply is 1 billion tokens, right? Then, is that correct? Yes. So the circulating supply right now is 135 million, which is about 13.4%, right? Which means that the price right now is 5 cents, but there needs to be like an 85% increase of more tokens that are yet to be generated. Because they come from the seed, strategic, pre-sale, and private sale. That's what they're called. Yeah. So there's a huge portion of tokens yet to be released. If FN in the meantime, cannot create utility, which means utility increases the demand for the token. What happens?
It's going to keep going down.
It's going to keep going down, inevitably, right? Basic economics. They could do all types of other shit to prevent that from happening, marketing push, land sale, buybacks, but we're not considering that. We're just considering basic economics, and in basic economics, that's how it works. So you are correct. The question is, why are the vesting schedules designed the way they are designed? So when you look at the vesting schedule, let's have a look at the one from the price, right, on the public. So we take a public round. They have a 10% release at TGE, and the seed has no release at TGE. Why not?
Well, they're able to buy it in very, very cheap. But let's see, they bought it for 0.03. So they still have a profit right now, right? Or how much is FN going for right now?
Yes, 80% up.
Right. So they don't need a release at TGE. They get it for such a low price. They'll have profit almost regardless, even half a year after.
Is that a fact or an assumption?
Yeah, it's an assumption. But,
well, in this case, it's a fact, but only for this project. So the thing is, you can never look into the future, right? So we would assume if the price difference is this big, that would be profitable for them. But it could go down more, and then they're not profitable because it's quite close, right? It's 5 cents, and this is 3 cents. There's also a seed round of 2 cents, right? But if you did strategic for 6 cents, you're still down 10%. Right? Yeah. Compared to the all-time high, which was a 3,000% gain. And for strategic, it was also a 6-month cliff, 18 months vested. So these guys are down, these guys are up. The question still remains, why the difference? Why do these guys get 10% TGE and these guys don't?
Mm-hmm. I feel like most of the reason lies in, again, the fact that they get the tokens for the low price. If they get it for such a low price and they were able to sell at TGE, they would have made a 800x and they would have all dumped the token right away.
Yes. So therefore, you cliff them.
Exactly.
Okay, that makes sense. So what makes a decision to, for example, these guys, they got in 100% more expensive, right? 3 cents. This is 200% here, 2 cents, 100% is 4, right? And then add another 100% from the base, it's 6. But the vesting schedules are the same for these groups. Why?
That's a good question. Let's see, they have to pay more for the token, but they get the same vesting. Does Seed also have a cliff? The 2 cent. This one as well, okay. See.
I don't think this is accurate. This must be the same.
Right. Okay.
This is not
well,
accurate.
then I actually don't have an idea. That it's quite odd to me. There must be a reason behind it.
Yes. And it's important to take into consideration for the vesting. So let's assume that the vesting is the same, right? We might not know if it's super accurate, but for the example, it doesn't change the outcome. So the vesting is the same, which means that, yes, the people that got a lower price have more relevant relative profit, right? But there's 2 very important things to note here. Why did these guys get a lower price?
The seed round.
Well, this is also a seed round. So there were 2 seed rounds, but the difference is quite big. The difference is 33%, 50% off the base.
Yeah. Must have been people even closer to the project and to the owners.
So the lower price you get, the closer you are to the owner.
I feel like so.
Yeah, sounds kind of dumb, no?
Well, friendly politics, or however you're supposed to call it.
Maybe.
Reaching out,
but there must be another contingency to it to get that lower price, because you can be my dearest friend, but it doesn't justify a 50% markup.
Yeah, in that sense. So that is because they are the earliest investors into the project. So there's the biggest risk to it.
They take the biggest risk.
But they're usually also the biggest friends of the boss.
Could be, but I don't think so. They take the risk because they trust the founder because of their friendship, right? But it doesn't justify the price difference. So the time of the investment, the timing, that justifies the price difference. Earlier, more risk, lower price.
Makes sense.
Okay, so that's one side of the equation. Perfect. What is the other side? Because now you could say, okay, I got in 3 times more expensive from the first seed round compared to strategic. Strategic, you're still 6-12 months before TG, right? So you still need to wait a long time. Then you're also cliffed 6 months. So it takes at least 1 year to get your tokens, likely, right? As a influencer promoting this project, which is not me, unfortunately. I covered FN a lot, but we didn't do the strategic with them. Should have,
well,
but didn't.
Unfortunately, that's a -10 if you had, so.
Nah, but I think this project will do really well. So if it's -10 with this much of a bearish trend, then it's going to be A-okay for the future.
Right, gotcha.
But is it really fair? Because yes, I waited less long, right, compared to seed, but they have a more significant return. Why are these vesting schedules then all the same? You would assume the higher the price, the shorter the vesting. But they didn't choose that. And in this example, it makes sense. But there's only one explanation why you would do that.
I'm not the one going to give that explanation. I don't know. I have no idea.
So the main thing with these vesting schedules and like math and tokenomics in general is there is no assumptions, right? It's all in the data, which is the easiest thing, because as soon as you understand the data, right, which I'm trying to teach you and everybody watching this, you can always argue very solidly because the data doesn't lie, right? The data doesn't change. So the only assumption you can make, right, which is justified here, is that the effing team is positive that after 6 months of the TGE, the project token would be at around this price or higher. And that is 100% true. So they started vesting the 30th of July, right? Which was a couple of 6 months from the first, 30th of July. So the vesting happened at 5.5 cent, right? Which was just under strategic. So for them to release these tokens, these guys are not going to dump, right? Because they know that they don't have profit. And these guys are only going to dump very little because they could make a lot more money, and they are the longest investors. They need to wait a long time for their tokens. So by cliffing them all the same, all they need to know is that it's not below 3 or 2 cents. They need to be around 6 cents. And what happens is they're perfectly around 6 cents.
Right.
Is that pure luck? No. There are a lot of economic trends and manipulation that can happen to end up in this situation. But on the execution, 10 out of 10. Right? So there's a reason that you don't need to cliff them longer per se. You could cliff them longer, but there's no good argument in this case, because ultimately you would want to feed your seed investors some returns, right? Because at 160, 80% ROI, the seed investors are going to liquidate, right? They're going to drive the price down a little bit more, but not significant because they didn't raise that much money, right? 200K, 900K. And the pre-sale price, which was right here, which is 10 million, right? This is 10 days lock, 6-month linear investing. Oh, I didn't have private. I had pre-sale. I think I had pre-sale and IDO. So in this case, this already has been fully diluted, and that was 8 cents. So it's no coincidence that after July, it went below 8 cents, or even before then, right? Even in June, it went below 8 cents. And very much measurable against the vesting schedule. You see?
Yeah.
So whenever this is fully supplied, this one, the price jumps below 8 cents. It makes sense. There's no utility for the token, right? And people are being fed more and more tokens. Ultimately, when it goes below, I haven't sold anything. Why not? Because I'm not going to sell at a loss, right? And well, I did sell my TGE amount at the top as well. So I was quite lucky. But I think I recouped like 70% of my investment on the first day. And that was the 10% TGE. And then I just kept sitting on it. I did with the public grants.
You did the public grants as well.
Yeah. So that way, it was quite nice. But of course, when the market is bullish, everybody ignores these vesting schedules, right? Because, it's like everything is going 10,
Profit
20,
anyways.
50, 100x. Everything is amazing up until a point that it isn't. And then you understand that these vesting schedules are really important. Now I have some questions. Now you understand the vesting schedules better. There's obviously a whole world behind these vesting schedules, but what would be the reason that a project would say, you would invest, right? I have a company. We're going to make a game. You ask, okay, I want to join the private round, right? It's usually the biggest race in that round. I'll tell you, it's 0% TGE, 12-month cliff, 36 months vesting. How many years is that?
Oh, definitely more than 2.
We need to work on your math, okay? 0%
36
TGE.
Yeah, there's nothing.
12-month cliff.
That's 1 year.
36 months.
That's
vesting.
2 years. So
no,
I was right.
That's not 2 years.
36 months. It was 12 plus 12. Ah, okay, gotcha. Okay, that is
how many years?
3. That's 4 years in total.
4 years in total. Perfect. Not 2.
Which is still
years.
more than 2 years.
Yes, but not 2. So 36 months is 3 years, and then 12-month cliff is okay. So 0, 12-month cliff, and then 36 months vesting. What could be the reason I give you this long of a vesting?
Well, clearly you don't want me to dump my tokens, and clearly you have the idea that your project will increase in value over time, I may assume.
Yes. So the most important thing here is the question, when you say you don't want me to dump the tokens, that's not true, ultimately, because when you invest into my project, the tokens need to re-enter the supply for the utility to use, right? For users to use the token, what the purpose of using it. So ultimately, I want you to take profit at some point, liquidate your tokens so they can be used on how they were supposed to be used and not just hold in your wallet. Because then you are diluting the supply in a negative way by keeping them out of the ecosystem.
For
right?
too long.
So what would be the reason, again, to keep them for that long?
That's a good one. Let's see.
Because what did you say before? We don't want you to sell. That's somewhat true, but that's descriptive. That's not the reason, right? They wouldn't tell you, we don't want you to sell. That's not a reason for a business because we don't make that choice. You make that choice. You could liquidate at 99% down, right? But then you're still selling.
Fair.
So they don't want you to sell, but for a different reason.
Okay, I don't actually know. Why would selling the tokens is, in my perspective, a bad thing overall? You don't want them to sell your tokens.
That's not true.
Okay.
So let's say I do a race, right? For $10 million, which is half of the supply of the tokens.
Mm-hmm.
And then I launch a product, everybody loves it. 10 million users in 1 month. But the price of the token is going from $1 to $100 because half of the supply is being held by investors, which don't want to sell their tokens for whatever reason. And now my whole product is fucked because all of a sudden the price to enter the platform is $100 and it was supposed to be $1. But there's so much demand and fucking investors don't want to dump their tokens. Therefore, they will take profit at some point. So the price goes up, supply and demand, then they dump and the price goes down, which makes it accessible for people to make an entry.
More people, right? Well, I suppose that's
Oscar had a good suggestion for you.
The long roadmap. Big ecosystem which need long time for building. The second one, yeah.
Makes sense, right?
It does make sense, yeah.
So what does that mean if they need a long time for building? Because that's a descriptive term.
Mm-hmm.
And we don't like descriptive terms.
Oh man, so we have to use a business term.
Yes.
Developing?
Yes, they are developing. What does that mean for the financials?
Mm-hmm.
From an investor point of view.
Right.
So
well, it means the ecosystem is not done yet. So it's still being in development. So they're taking money, but they're not necessarily producing money yet. So they need the money to invest back into the company. Not quite.
They already raised the money. So the money is already theirs. But you were in the right direction. So you said they don't want you to sell the token. Why not?
Mm-hmm. They need the money. Wait, they already have the money.
They already have the money.
All right. They don't want you to sell the money Because you have to keep the price in check.
Yeah. So what happens if you sell?
Price goes down.
Why?
Supply and demand.
Yeah. And what does that mean?
Means that there's more supply than there is demand because of my.
And why is there more supply than there is demand?
Because there's more tokens entering the markets again.
Why?
Because I'm selling my tokens.
Yes. So why are you selling your tokens?
Probably because I thought I could make some profit.
Yes. And okay, Oscar is helping.
Token's not usable yet. Right. If the ecosystem isn't done, there's no utility to the token.
Okay, so then there's no demand, but there is supply, so price goes down.
Yes.
So
exactly.
It's not that they don't want you to sell. You can sell, but you will likely sell at a loss because everybody is in that circle. So they have a long roadmap because they need time for development. While they're developing, they have no product. Because they have no product, they have no utility, but the vesting schedule would be running, which drives investors to sell, and the price goes down and they ruin their own project. So therefore, they would make a long cliff. So if they do 0% TGE, 12 months cliff, how much time until the beta?
Let's see. 0 at TGE, 12-month cliff, probably 12 months.
Probably 12 months, because they
Right.
forecast that around that point, they will come with some utility for the token. Obviously, when they say, thanks, Oscar, I'm glad you like it. When they say, you know, we have staking, that's not a real utility, right? Because the thing is, that basically locks up tokens, but dilutes the supply over time because it yields more tokens, which is the same as vesting, which you don't want, right? So let's say 0% TGE, 12-month cliff, 36 months vested. Why would you then vest them for 36 months? That's 3 fucking years. That's a long time.
Right.
But a lot of certain type of projects do this. Why?
I think it still comes down to the development of the ecosystem. I mean,
Yes,
you might have a beta
that's
after
part
12
of it.
months, but it's not going to be done yet. So you still want these people vesting.
Yes, but what does that mean in concrete terms? Did you notice my sum up? I went from A, B, C, D, E, F, G, gang. And that's how you need to make your sum up too, if you fully understand the picture, right? So they want you to have long vesting because the game will need long development time. Why would a game need long development time? Or any
Complex
product?
game.
It's a complex game. And usually what does a complex game mean? It's a big game, right? So we're looking MMORPG, AAA titles, 3 to 5 year roadmap, right? Because they have that large of a game, crazy visionaries, they're also going to build the game in blocks. Usually they don't release the game at once. They basically, after the initial 12 months, they run the beta for the first part of the creative game world, right? And in that section, they bring the first utility. So when they say 36 months, what are we looking at? Star Atlas, Big Time, Illuvium, and they don't even have 36 months. But right now, Gunzilla, right? Legends of Mavia, they all are like big AAA titles, crypto AAA titles, and they have long ass fucking vesting to basically ensure that they have enough development time and then marketing time to create the actual utility for the token, which for me is a big problem. I changed my mind, right? I invested a lot of money into Gunzilla, for example, right? I think over $6,000 and other games with long runways. Why? So there's pros and cons to it, right? Yes, they are potentially building something amazing, but what is something to consider when you have these long vesting schedules?
It's a lot that can happen in 3 years.
Yes. And in which industry are we working?
In crypto.
And what happens in crypto is that, you know,
3
3
years
months
is 30
in
years.
crypto, no, the other way around. 30 years happens in 3 years. So
that's what I meant.
If crypto, exactly. If crypto develops, you know, in 1 year, the market will look completely different. So if they're using a 4-year roadmap, that means that during those 4 years, a lot of things need to be adjusted. And what is one of the most difficult things to adjust? Tokenomics. right? Because it's the whole economy of the game relative to the token designed on the market right now. So a lot of games right now are looking to restructure their vesting or tokenomics because they designed their game in a bull market. And they didn't take into consideration the bear market. And that, tokenomics are not easy, right? First, you have to understand economics. Then you have to understand token utility. Then you have to understand the project and then tie them all together, which is why Tokenomics Advisor is at least 1 or 2% of the circulating supply, right? Only tokenomics. He doesn't advise on other jack shit, just simulation of the economy. Will fucking charge you $400,000, $500,000 for this. But super essential for your project, because if it's not done properly, and you need guys with experience that do this full time, or some know-it-all on YouTube that reviews a lot of white papers. But the thing with these vesting schedules is they can be very dangerous. So now we look at the other side. We go from, let's say, 36 months vesting to 100% TGE.
Interesting.
Yes. Why is that interesting?
Well, I mean, if I look at these graphs, man, we're seeing TGE is a massive spike, and after that, it just drops down. If I was an investor and I had 100% at TGE, I would just drop it right away. Big profits, I would drop everything. Yeah, why not?
Okay, recap what you just said.
I get all of my tokens at TGE.
Yeah.
Which is usually when the price is at its peak.
Usually when it's not 100% TGE.
Right, otherwise, okay, fair enough. Okay, yeah, sure.
So what happens with 100% TG? What is the market doing?
That's a good one. Yeah, so I suppose if you do have a 100% TGE, you're not going to see the usual pattern of a big spike up and then down. It's probably going to go straight down before you get a chance to sell anything with profit.
Why would it go in a straight line down?
Let me think. If everyone, well, okay, fair enough, right? If everyone knows that they get 100% of their tokens right away, maybe they wouldn't sell. Is that what you're trying to say?
No, because let's be honest. If there's $100 billion and we both have a gun, and you would say, I won't shoot you if you don't shoot me, and we can split the money, you can walk towards the money and I'm gonna fucking kill your ass. Right? When you're not looking. So if you're like, oh, let's not dump because it's 100% TGE. As soon as these motherfuckers see profit, they dump. Right? So the dump will happen with 100% TGE. The question is, there is more supply than there is demand, right? At that point. So price goes down. But how does the price move down? Because you could still make a lot of money with 100% TGE. What does it come down to ultimately?
Speed?
Yes. It's just a speed race. Who has the fastest internet? Who can claim and dump the tokens as fast as possible? Right?
Isn't that like where bots were made for it? Like these immediate sell bots that just sell at the first microsecond, get the highest price.
Yeah, those are Schneid bots. They do something else. But we have, so with Crypto Winter, like in the bull market, we looked at an extension called Token Dumper. It's actually with Digits Club branding. We might revisit it in the future, which basically claims and dump the tokens automatically. Quite cool. For like the best price. It's like a Python script. But like these tools, yeah. So that makes the price go down, right? Who's the fastest? But for a project to decide 100% TG, they must think something, right? Otherwise, everybody wants to do a lot of access because it's a good indicator, right? If your project pumps on TGE, it means it's good, right? Oscar is saying cash grab over real demand. The market regulates itself. Well, not really, not on a TGE, because then there's a lot of things you could do to influence that. But that's like for a different video, perhaps. Why would a founder do 100% TGE?
Maybe he's looking for this big X on his project.
No, because we just said that it's going to go down with 100% TGE. So if he's looking for a big X, he's going to do 0% TGE, 10-year cliff.
Right. Okay.
Nobody gets tokens.
Yeah, good question. I can only imagine that it would be a negative thing. Like he doesn't have much trust in his own project, and he just wants people to invest because no one is investing when he puts a cliff. So he just puts a 100% TGE so to get people interested in the project.
Okay, let's say we deploy the Digits ecosystem, right? We do the token, and we're going to charge everybody in Digits coins for our services that we have, all the different products, right? I can do 100% TGE and the price won't dump. Why not?
Because it has utility. You don't want to sell your coins.
Yes.
Oh, okay. I see where this is going. I guess a project will have massive utility who does a 100% TG.
Right. Or they believe they have a lot of demand for the token, right? And this is where it becomes complex, because I've talked, obviously, even on AMAs, we spoke with Planet Mojo, Blocks, and every single time I call them out. On these calls, I don't give a fuck, that, right? Every time they say 100% TGE, because we have utility, I call bullshit, right? Because I say, you don't have any utility, right? Because your products are not done. Yeah, but we have staking and liquidity pools. So we trust that the user will provide liquidity or stake their tokens. And what happens? Whee! Because those are not real utilities. Those only dilute the supply, right? And that's like saying like, oh my God, yeah, you buy a car and then I give you like half a tank of gas. That's like a gift. It's special. No, bitch, I need to ride it off the parking lot. So you need to put some gas in it. I paid $20,000 for this car. Put fucking $100 of gas in this bitch, right? And that's like project founders just having a huge hard on, like, oh my God, we bring utility on day one. That's not utility, mate. That's basic crypto shit. We got a staking dashboard. We got an NFT marketplace. If you're on the Binance Smart Chain, that's the minimum you need to do, because it shows that you're not like a fucking another scam token, right? So very important, with 100% TGE, there must be significant direct product-related utility or price will go down. What that means in simple terms, there need to be demand by users for the coin for usage on the product, not to stake, or because the staking will happen, right? 10-20% of the users will stake, but 80% won't. And that is the problem. Even if it's 80-20, it might work, but the other way around, it doesn't work. And that's why launchpads, for example, are so important. When you have a lot of vesting, so let's pull the screen share back. So you can see that on these vesting rounds of these launchpads, 100K, 400K, 100K, 80K, right? 25K, that's quite little, but let's take these for example. Game Station, Paid Network, Communitas, right? I think this is a good example. Paid Network relative to Communitas, right? Or you could say CDeFi relative to Communitas, or True P&L. Why would they assign lower races to certain launchpads? That's the question.
Lower rates as in cheaper to get allocation? No,
they just get less assigned allocation. So CDeFi gets, for example, $500,000 that they are allowed to sell, but Communitas only 100,000. So one of the reasons is CDeFi is the bigger launchpad, right? That is just from a company point of view, but there's also a practical point of view, which is important relative to the vesting schedules.
Yeah, maybe it has to do with the type of people on the launchpad.
And what type of people are there on these launchpads?
Well, different type of investors. Some launchpad have bigger investors, people with more money to spend on launchpads.
Okay, so
other launchpads,
we have CDeFi on the one hand, and then Communitas on the other hand. So what is the difference between these two? And why is the relative vesting schedule important, therefore?
Well, CDeFi, for starters, is a lot more expensive to get into than Communitas.
Yes. So what would that mean?
The investors on Communitas will have more money, more investment money for allocations, I would assume.
I think you assumed that wrong. Please explain the logic behind it.
So if on Seedify there is a higher amount of money needed to get into a tiers, to get an allocation, we could assume that those people that get those more expensive tiers will invest more into a project. So they will be able to fill up more. If Communitas is filled with a lot of small investors, we can assume that they're going to invest small amounts into these projects.
That's the opposite of what you just said, but that's perfect. Yeah, that's correct.
That's what I tried to say, at least.
Yeah,
so
okay.
My bad.
Yeah, that's perfect. Yeah. People who buy more expensive tokens usually have more money to invest, right? I want to give you an example of, let's say somebody drives a Ferrari, other one drives, say at Ibiza, then assumingly the person in the Ferrari earns more money, assumingly, right? Same thing with these Launchpads. If you buy more expensive tiers, assumingly you can invest more, right? Relative terms. So what does that mean for the vesting schedules? Why would a project allow Seedify to sell more relative to a Communitas?
Well, you will have to fill it up. So you can give Communitas the exact same amount of Seedify, but if they can't fill it up, then it's useless.
So that's basically the Launchpad's problem. So that's usually where we put our focus. That's 100% true. But there's also a business alternative. So let's say they could fill it up. Why wouldn't we give that much to Communitas?
Interesting. Maybe because they feel like there's no argument to this, what I'm just going to say, so it might be wrong. But what if
racist?
No, okay. What if they were to immediately drop the token for whatever reason because they're from a certain Launchpad? Can there be any? I mean, imagine the people at Communitas might have a reputation of immediately dropping at TGE, and Seedify are more long-term.
Why would that? Because it's not about the reputation; it's about facts and numbers, right?
Statistics.
Yeah, smart guy. So what are the statistics?
Business terms. Well, again, I don't know the statistics, but from what you've just said, I would assume that the statistics are that Communitas investors are investing smaller amounts and are dropping more off TGE, and Seedify invest larger amounts for a longer amount of time.
Why?
Good question. I don't know.
But it makes perfect sense how you just explained it.
Yeah, it does. But the only logical explanation I have is they're more experienced investors.
Yes, that's also true. Everything you're saying is true, but it's all descriptive, right? It's difficult to find the right terms to use. What it comes down to, let me give you an example, right? Okay, you have $10, right? You give me those $10, right?
All of it.
And then I tell you, I can give you $20 back tomorrow, or wait 30 days and it might be $100. What do you choose?
$100. I can wait.
Yes. Why would you choose $100?
It's more money.
Yes. Do you need the $100 or the $10?
Nah.
Okay, that's the thing. Relative to your holdings is little money, right? And we would reflect that in GDP, gross domestic product, what we talked about in those are worldwide economic terms.
Yeah, previous Launchpad collection.
Yeah, for the relative Communitas holder, when they invest little, $10, and they make a 40% gain, that's enough to take profit, because in their currency, their country, their living standard, that's a good money, right? And for the average Seedify holder, so let's say Communitas is from Indonesia, the company, right? The average investment is maybe $10, which is maybe a day's worth of work, right? $10. So if they make $10 profit, then they gain a day's worth of work, and that's good to get in terms of ROI. But for the US, a $10 return would be less than an hour of work, right? So they need to get 8 or 10 times more return for the same intrinsic feeling of that money.
Right.
So because of their GDP, their relative investment is lower, which is a good thing for the project because you have a bigger spread on the money, right? There's more participants and some people might hold. But they're likely to dump faster because they need less relative profit. And they're still investors and not participants, right?
Right.
One thing to keep into consideration with vesting schedules, therefore, when they raise money, the higher the tier of the Launchpad, the more money they can raise and are allowed to raise because they have whales there that will just hold the tokens, not even stake them. right?
No.
They more institutional investors up until some degree. But very important to keep that in mind, why certain groups get certain higher allocation. And now the most difficult question of the day. No, maybe, I'm not sure. So when we look at these rounds, IDO, right? IDO, 14 cents, 14 cents, 14 cents. And they raise 250, 350, 750, 850, let's say about 900K, right? Then private was 4 million. 4 million together, those two. The pre-sale, what is basically the private sale that they hosted themselves a little bit later, right? So basically the private sale was about 15 million, right? 14 million, just the strategic 2.5 and seed 1.1, right? Just combining them real quick. So the private sale is the biggest portion, right? If we look at, let me see. So private and then pre-sale, is that listed here as well? Yeah, pre-sale and private, it's 21% of the entire tokenomics. That's a lot, you know?
Right.
Why would they raise so much on that pre-sale private price and not push more to IDO or push more to other rounds? There's obviously a reason, because private is always the biggest race on well-designed tokenomics. Why?
Yeah. Okay, so I'm not going to have a complete answer, but I do know that the public round is mostly for marketing purposes. So it's not made for raising a lot of money. The private sale is mostly targeted through people who are really interested in holding for a longer period of time and who are not immediately going to dump the token, which you have a higher chance of with the public round.
I appreciate you trying so hard, but that's not true. Those are, again, assumptions without underlying facts. But it's interesting that you're so confident in, like, yeah, it's this. Not really. Good salesman.
Oh, I'm not confident at all, but you got to sell it. You got to sell it somehow.
It sounds good. Yeah. That's the thing, right? It sounds good.
Absolutely.
No, it's like, again, it's economics, right? So every time we talk tokenomics, it's token economics, right? So it's economic reasons why. So Oscars has more investors. Not specifically, right? Because in the seed round, there would be a lot more investors interested for that price, but you don't want to take that much money because then they have too many gains, or you sell them too cheap, you raise less money, right? There's always pros and cons, and that is more the users. Thing. So
Oscar says,
when you go higher price, usually less interest, right? Because less potential gain, but also less risk. So it's pros and cons that you need to balance. So why in the private round do they raise the most money?
Best balance.
Best balance between what?
Between risk and gain.
Risk and gains. It's the best balance right there for both the investors and the project, because they already have raised enough money to show their validity of the project, but they haven't raised enough money to fund the entire project. And therefore, the private is the biggest. It has the best balance between price and vesting at the same time. So when you judge tokenomics, it's easiest to pick the private round first, where the most money is being raised, because if that's solid, then the other ones will be supportive. They might not be as solid, right? But they will be supportive of the private round. If the private round is a mess, then what happens is that the whole rest is a mess, because the money outweighs the rest because they're economics, right? Why? Okay, what? So here with Effin, we had seed round 1, seed round 2, strategic, private 1, private 2, and then IDO. They gave it different names, but that's usually how it works. Is that common? Or I don't know if you've seen many vesting schedules. I don't think you have, but
4 usually.
4. So seed, strategic, private, and public.
Yeah.
But these guys have seed 1 and 2.
Yeah.
Why would you have 2 different seed rounds?
I don't know.
I know, because it's shown literally on the screen. Let me pull it up. Look. Why would they do 2 different seed rounds?
see, one is cheaper, one is more expensive. Let's see.
Yes.
Which
So that's
one went
one part.
first? By the way, the most cheap one, I assume.
Yes.
Yeah.
So the price is
I still
one
don't
thing.
know. Right. Yeah.
But what is the other thing?
Time.
Well, yes, but less significant. Not the factor I'm looking for here. Metric. Looking for something else.
Okay.
Marco
why
is
would you
saying
do
the
two?
seed one did not fill up. That's not true, I'm afraid. I'm not sure if it's not true for this project, but I'm looking for something else, which is applicable to all projects. So why are they, so how many metrics do we have? 1, 2, 3, 4, 5. Right, so it must be one of these 5. And one is price, so there's 4 left. 25%, if you make a guess, you're correct. It's one of these 4.
Okay, let me take a good guess. Let me calculate my guess real quick.
If you can't get this, you're done.
Okay, damn, that's pretty. I don't know. I'm done.
No, there's 4 rows here. So one is we would do 2 seed rounds because the price is different.
Yeah.
Yeah.
Yes.
So ROI is calculated past the TGE. All-time high ROI is calculated past the TGE. So there's only 2 metrics left.
The raise and the tokens for sale.
Which is basically the same thing. Because this is a mathematical equation.
Right. Yeah.
And this is the amount of tokens for sale.
Yeah.
So why are there 2 different seed rounds?
Yeah, different raise. Yeah, different amounts of tokens for sale. But I don't
different
see...
amount of tokens for sale for a specific price. So here you can say, I want to buy 100 million tokens. It's not possible because the raise is only 200,000, right? So this round came first. They raised 200,000, likely pre-seed, right? They call it seed 1. And then later, once they had like the whole white paper ready, they said, we do another seed at a little bit higher, 3 cents, but we will push a lot more tokens for sale, raising 900K.
But why?
So the difference, why you would have a seed 1 and 2 is you can't combine them for a total raise of 1.1 million because and the price is different and the tokens for sale is different. Because if you would basically multiply this with this, then you don't get this raise. Then you only get less, right? You only get 300K and not 900K. So there must be either more tokens or a higher price, and in this case, both. And therefore, they raised 700K more. Make sense?
A little bit.
So the main difference between the different rounds is price is always different because otherwise they could just combine it. And then the tokens supply is usually different, right? Doesn't always have to be different, the token supply, but the price for sure is different because otherwise they could just combine it, right?
Yeah.
So what you often see in non-public information, so like equity reports and everything, is that there's never one private round because they raise so much money. The average private round is usually between 2 and 4 rounds. And what's the difference between those rounds?
Different price, different amounts of tokens per sale.
Okay, perfect. See, you understand. When you say, oh, I think I understand a little bit. No, you get it. Different prices for different amount of tokens for sale. Why would you then display on your white paper only one private? Some of them show all of them, right? Very transparent, but most of them don't.
Yeah, interesting. Why wouldn't they want that to be transparent to the community about the
No, that's not really the question. The question is, why don't they have to justify it?
Because it's the same round. It's both private. It's just a different...
But the price is different.
Different private round.
So if you get in for 0.15 and I get in for 0.2 and they display on the white paper 0.2, that's not true because you got in for cheaper. And I'm making my investment decision on 0.2. So you are going to dump on my ass because it's a 25% difference, right? So it's likely that they will not put 0.2 2 on the white paper, they will put a different amount. So which amount are they going to put on the white paper?
Lowest one.
That's also not true, because then I'm fucked. I can see that they're screwing me over.
Yeah, but I can hardly believe that they just put the highest price on there.
Yeah, but they also don't put the cheapest price on there.
No, they put the average price.
They put the average price.
They put the average price. That makes.
But you can only put the average price if all the token rounds have the same amount of tokens, which usually they do. If they don't, you have to use a weighted average, and then they cut up the rounds. Why? Because if you use a weighted average, then the price will be hella decimals.
Right, yeah.
Right? So usually what you see is, for example, 0.11, 100,000 tokens, 0.115, 100,000 tokens, 0.116, 100,000 tokens. And the small discrepancies between the numbers are justified because they say these are people that wanted to join the strategic round for marketing, promo, or big VCs that can add value to the ecosystem products, but they couldn't because it was already sold out. So we cut up the private sale for them. And because, for example, a party buys, 10 million worth of tokens, like a super big sale, or let's say 1 million, they get a little bit of a cheaper price, but only 0.1% discount or 0.5% discount, never super significant. If it is super significant, something is wrong, right?
Right.
And therefore, when you have a project, right, any project, when you look at the vesting schedule, which ultimately is the tokenomics, right? So the tokenomics is one, the allocation per where the money goes. And on the other side, it's the vesting schedule. These two are 100% interlinked. If you would give me a project, I can judge the quality of the project based on the tokenomics and the vesting schedule. If that is adequate, it doesn't have to be a 10 out of 10, but if we grade it, let's say 7, 8 out of 10, good enough, then we can review the rest of the project. Why is this the best way to review crypto projects? Because most of the time, projects look amazing marketing-wise, right? Cool pitch deck, cool video, and then you look at the tokenomics and it's garbage. So then you wasted all your time reviewing, getting hyped up. I like the founder, I like how he speaks, but a product is not charisma. Charisma is a human skill, and he's selling you his project. So you might really like the project, but you just like the guy's what he's trying to sell you. Remember, there's like this classic marketing image of like this, what's it called? Like this children thing from, what's it called? Like a swing from a tree.
All right, yeah.
And like, it's like what the developer thought about the swing, what the marketing team thought about the swing, what the sales team, and you see when it goes to marketing and sales, it becomes like super luxurious. And what the customer gets is just 2 pieces of rope with wood. You remember that one? Let me see if I can find it. Marketing image swing. Because that's like, it's like a classic one in most marketing books when you have to stay realistic with the expectations of the customer, that you cannot keep selling them dreams, and when they get the product, they're disappointed, right? Therefore, under promise, over deliver is quite a big statement these days when a lot of companies trying to oversell shit. Oh, here we go. I got it right here. 1 second, yeah. Let me pull it up.
Yeah, of course. I'm excited for the picture now.
Okay. Now this is a more simplified version, but it's still the same. So how the customer explained it. I want a swing with 3 of these things, right? How the project leader understood it. Okay, swing with 1 thing. How the engineer designed it. Okay, we make it super cool with extra support and then cut 3. How the programmer wrote it. Okay, rope with 1 wood, right? How the sales executive described it. Like a full sofa chair with like lights behind it. How the project was documented. It wasn't documented. What operations installed? Just the rope. What the customer was built, a full roller coaster. How the hell that supported it if there wasn't any tree, and what the customer really needed was just a swing with like a thing to sit in, right? And this is basically the whole journey when you look at the product which is not developed yet and solely go by the website, right? Other founders tell us all the time, your websites look amazing, the perceived value is really high. Obviously we showcased some individuals as cinematic. It's like, oh my God, this is like 8-9 figure value. And it's like, that's just perceived value. That's not utility value, right? So you have to be very careful in general as an investor that perceived value is only what it is. Value that is perceived, but not factualized based on actual billing, right? Or economic movement. And with these vesting schedules, you can basically see, okay, 100% TGE, let's take the roadmap. If the roadmap doesn't have any release in the first 6 months, it's going to be a disaster. And then you have all these little tricks that we could into, like manipulate liquidity and all kinds of stuff. But that's all shadiness, right? That has nothing to do with like operating a good project. So ultimately, the vesting together with the tokenomics, perfect match.
Yeah, very interesting, actually.
Now I'm tired.
Yeah, I imagine you talked for an hour.
No, but this is like one of my favorite things, right? I mean, these tokenomics, they're extremely interesting. And this is like what makes the big difference between understanding what you're doing and how you're doing it. And just, I think 99.5% of the people that join Launchpads, they cannot explain any of this because they just don't understand. They're just gambling, ultimately. Right? Oscar is asking for part 2. Inevitably, we'll be back next week. Maybe we continue on the vesting because there's a lot more to explore. Perhaps we go more into tokenomics because on the tokenomics, we only did the categories, right? And there's a lot more to it. But I would have to look for some examples beforehand. Definitely interesting. To be
I'll be
continued.
interested too, for sure.
Well, good. I'm glad to hear that. Rick, any questions, final arguments?
No, I'm loving it. I think we should definitely do a follow-up somewhere in the future.
Alrighty, awesome. I'll note it down. Vesting part 2. Everybody that participated live, thank you for joining us on the chat. I appreciate you. Rick, thank you so much for being here once more. We'll be back next week with Launchpad School in the Digits Club Discord. Thank you so much for watching, and we will see you in the next one. Peace.
Bye-bye.